Welcome to Subramani. During market volatility, there are some common pitfalls which we should avoid because managing risk, diversifying, and trying to keep emotions out of your decisions will all help you protect your portfolio and, far more importantly, help you sleep well, because it is not as though people are worried that their portfolio will go to zero or things like that, but they realize that, oh, something is wrong, I need to do something, that need for action, because, oh, market is falling, I should sell, market is falling, I should buy, something, some action they need, right? So let us look at some of the common pitfalls. First, do not take unnecessary risk. If you're 80 years old, you have 20 crores in your bank, your annual expenses are 5 lakhs, there is no reason for you to take more risk. You're not going to add anything of great value to your life. I mean, the amounts may vary, but for most people, the need to take risk is gone away. So let us look at two things. One is risk tolerance. How much risk can you, risk tolerance and risk capacity are the two views two ways to look at risk. Your risk tolerance is decided by how comfortable you are with risk, right? Risk capacity, on the other hand, is the need to take risk to achieve your goals. So make no mistake about that. Managing risk and deciding how active you need to be is determined by answering both these questions. Are you comfortable seeing your portfolio dip 20-30%, right? Are you willing to do that? Significant drops and staying there for a long period of time, maybe 6 months, 8 months, 2 years, right? If it stays there, does it impact you? Second, quantitatively speaking, how much can you afford to lose? For instance, one person might be able to see their portfolio drop by 20% or 25% also, right? So he's got, that is his risk tolerance. But given the size of his portfolio, maybe he has just 1 crore of rupees, he is 48 years of age, he knows he has to retire, he knows he has to pay for his children's education, etc., which means the ability to lose money is not there. So there is no risk capacity. Risk tolerance is there, but risk capacity is not there. Only when your risk capacity meets your risk tolerance, that is the amount of risk that you can take. So compared to that, see how much risk you need to take, how much risk you are willing to take. Both those questions are important. Determine what your goals are and understand how important those goals are, how time specific they are. Right, once you understand all that, you can decide on the amount of risk. Like, for example, if it is your daughter's 12th standard, right, you know it is coming at a particular time, maybe 2027, 2029, 2032, whatever it is, but that cannot be negotiated. Your daughter's marriage, you do not know, it is not fixed. Your bigger house, your bigger car, all those dates can vary, but these are hard coded, right? You cannot afford to make any mistakes. So based on that, you will decide your risk capacity and your risk tolerance. So based on that, you decide how much risk you want to take. When markets are fluctuating, or rather when your portfolio is down 10-20%, it's a good time to be reviewing your risk capacity also. Second, what happens is, in the market, let's say mid cap or small cap are quoting at 5 times book. I'm not taking P, I'm taking 5 times book. And assuming that we are going to use that as a parameter. So it used to be 1.5 times book, now it is 5 times book. Now what happens is, in your mind, that 5 times book seems to be a fair price. Let us take the share price, book value is 100, it was normally quoting at 150. In a boom, it went to 500, right? So somehow in your mind, the past data is, there is a control or delete, so it is gone out, that 150 is gone away, and you think 500 is the new normal, which is what it is. When 500 falls to 430 or 440, you start itching and saying, oh my god, it has already fallen 20%, 18%, 15%, whatever. So should I be buying, should I be buying, should I be buying? Because you have been told that when market falls 20%, it is bear market, so it's about to enter bear market, so should I be buying now? But remember, it has gone from 150 to 500. It is perfectly possible that it comes back from 150 to 200, right? From 150 to 500 to 200. That is still higher than the normal averages. So don't get emotional. Look at the numbers and see, is it really come down, or has it just come down a wee bit? and you're very thrilled that, and you think, oh my god, I missed this share at 410 or 440. After, when I saw it at 440, I thought it was fairly priced, but before I bought it went to 500. Now I should buy it at 440. Not true, right? If it's a, let's say, a construction company which is not getting contracts, or a construction company in the road construction business which is not getting margins, then the price, it may not deserve 500, it may deserve 150 or maybe even lesser. So don't get emotional about price, because don't get emotional about a share which you've sold. Let's say that share had gone from 150 to 500 and you sold at 500. You were lucky enough to sell at 500. Now it is back to 450 or 440, and now you're thrilled, saying, oh wow, I made another 60 bucks. So let me buy it at 440. Again, emotional decision. The fact that you sold at 500 was perhaps luck. Now you don't have to make it worse by buying back at 440. Maybe it'll go to 300. So don't be emotional, right? And though I'm telling you this, it's not, I'm not the best person to tell you, but do not rely on a particular product or a particular asset type or a particular asset within that asset type. I've got shares which I must have paid in thousands, which is worth in crores now. Am I emotional about it? Yes, I am emotional about it. Am I dependent on that particular product, on that particular group? Yes, I am. But I'm still saying that's not a very sensible and a professional way of looking at it, right? So if the price falls, I'm answerable to myself. If you are managing somebody else's money, you're answerable to them. So they're bound to ask you, look at 30,000 shares of let's say HDFC Bank, why didn't you sell a little bit? You need not have sold everything, but little bit you could have sold. Or you have 50,000 shares or something, why didn't you sell of 500, sell of 1,000? Why didn't you do it? Something like that. So when you're taking such a huge portfolio risk, which means you're taking a concentration risk, and that asset is doing very well, be ready for the fact that sometime later your portfolio is going to look bad because of the over reliance on a particular asset class or a particular asset. It's happened to me, it will happen to me again, but I will be concentrated on equity. You be careful if you are not a very, let's say, equity bhakt, and you are worried that what could happen. You have to diversify. Diversification is a great thing to do, especially if you're not sure how you will react when the market gets a little weak, right? So diversification does not really improve your return, but it reduces your risk. So the return per unit of risk is better when you diversify your portfolio, but in absolute terms, returns may be very good in a particular asset class. Decide what you want. I've chosen equity, and I've chosen concentrated equity. So for me, that's fine. Sometimes your gut instinct tells you when to sell, but it does not mean that it will tell you when to buy, right? So you were perfect that you sold the share at 500. Now you have no clue on what price to buy it. So that is the problem with market timing. You get one leg of the timing right and you start believing that you're a genius. I've sold many shares at the top. Have I been able to buy it back at the bottom? Maybe once, maybe twice in my whole 30, 40, 50 year career, right? So sometimes it happens that you get the top and the bottom, but that's not the rule. You will not always get it. So if you have sold it at 500 and you're happy buying it back at 380, so be it, buy it. And then it falls to 330, buy more at 330, and then maybe the price goes back to 500, you sell it. It depends on your own strategy, but you don't have to remain static. But having said that, if you are a person who will look at shares only over a very long period of time and you don't really care, you look at, I may look at my portfolio on an annual basis, right? It does not really matter. I don't look at it on a day-to-day basis. Yes, I have a trading portfolio which I may be seeing every day, but my total overall portfolio net worth, I don't look at it. I don't even look at it quarterly, right? So I've reached the stage when I said, "ठीक है, जो होना है होगा." Having said that, if you are in that category, then there is nothing that you have to do during market downturns. You don't have to worry, is my mid-cap overpriced, is mid-cap underpriced. None of that. You don't need to do it. You're not a professional investor. You are an investor who has put 50-60% in large cap, 20-30% in mid-cap and small cap. You stick to your valuations, you stick to your ratios, you stick to your asset allocation. Don't bother about day to day what is happening in the market. Thank you.